Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it.
Okay, welcome back to Markets, Mystics and Mayhem. Now the Kiwi's done quite a bit of things. It's been moving around a little bit after the Reserve Bank's pretty dovish meeting, and it's fair to say it's been keeping our financial markets team quite busy. So today we thought we'd pull aside one of our senior dealers to just talk about what he's seeing. So we have here Adrian Lodge with us today, who, fun fact, was our very first guest on the podcast. Now, Lodge, you didn't need to wear the exact same shirt. You know, people recognize you. They know you're our first guest. But we have had a few more listeners join the podcast since then. So maybe just to start off, maybe you could reintroduce yourself and tell us exactly what does a dealer in Kiwibank's financial markets team do?
Yeah, thank you, MJ. I'm obviously wearing my shirt from last year. As, tight measures, obviously, with the economic conditions at the moment. But in terms of what does a senior dealer do? So what does a financial markets dealer do? We look after customers who are importers and exporters. They have a foreign exchange risk, and we are there as a specialist talking to them around their currency risk. So they'll come to us. Say, for example, an exporter has sold goods in US dollars and they don't get paid for 6 months' time. They want to talk to us about what the view is, what the currency is doing. Like, for example, the RBNZ dovish statement, what it mean for the Kiwi dollar, and what's our view in terms of direction of the currency. And we will then talk to them about how we mitigate that through using various products like forward exchange contracts or FX options or even spot.
Oh yeah, really interesting stuff. I guess it's all about just helping your clients just manage all that FX, the exposure that they get with the FX moves and everything. So it has been nearly a whole year since you were last on. I was looking over the last time you were on and we were talking about a US election. We're very much on the other side of that. Central banks' cutting cycles look like they're kind of close to wrapping up. So quite a lot has happened in that last year. What's the biggest difference you're seeing today from this time last year?
In terms of, I guess for us, it's, obviously the currency, I was looking back at when we did it this time last year in September. Kiwi was at 62, 63 cents. We're now sort of in that 58 to 59 range. I guess we were quite busy with importers were still doing a bit of hedging. This time round, I think we're seeing importers are pretty much sidelined. There is still activity out there, but a lot of importers, are choosing to sort of stay sidelined in terms of doing hedging, given the lower Kiwi against the US at 58, 59, especially against the Aussie as well, which is around that sort of 90 cent level. But I think there's still quite a bit of uncertainty out there in terms of the market conditions, and they're not really willing to commit too much. I mean, they're still buying currency, but they're just not doing it as much as they were this time 12 months ago. So we're seeing a bit of...
So they're buying it as they need it rather than hedging?
They're buying as they need it, and they're buying sort of maybe hedging shorter dated forward. So rather than doing sort of forecasting out 12 months in advance, they tend to be buying sort of 3 or 6 months, for example, and buying less of that currency because the volumes are definitely down, but also they're willing to commit to hedge the currency at the moment at the current levels. Yeah.
The volume's been down, to us that's just weak economic activity, right? Not much going on.
The demand on the other side,
Demand on the other side. You must be seeing quite a difference in what I guess your importer clients are seeing and what your exporters are seeing. It looks like the exporters are doing quite well compared to last year.
So on the export side, flipping it onto especially like around the Aussie side, at the moment we're still seeing a bit of demand out of Australia.
Yeah.
With exporters, especially with the Kiwi sort of being around that 90 cents. I mean, we did dip below 90 cents on last week on the back of the Aussie CPI number, that obviously higher than expected inflation number. So some exporters got on board and hedged that. Kiwi US, we did some top up in the sort of low 58s last week and the week before, where they sort of did the hedging. So they're still going all right. They're probably doing 80% of what they were doing. I'm just putting a number there, 80% of what they were doing this time last year. So they're still ticking along. And the currency is still favourable to our exporters in this current environment, which is what's showing through in terms of numbers.
Yeah. I guess the drop into the 58s is quite helpful for exporters, right?
Yeah.
Compared to 62, 63 like you were saying last year.
Yeah.
And that's an RBNZ story, right? The RBNZ finally playing catch up, finally cutting interest rates, and those interest rate differentials working I guess in favour of a weaker Kiwi, which helps the economy.
Absolutely. And you also got the Kiwi euro as well, down around the 50 cent level.
Right.
You know, down sort of from 53, 54, for example, to 50 cents. So you're seeing some of those exporters taking advantage of those lower Kiwi rates in terms of exchange rates.
Yeah. Yeah.
Going back to your importers, you're saying they're more looking, they've kind of changed their view where it's now more around the 3 to 6 month period. That takes us to around Christmas. So does that mean that their expectations around Christmas is that it might be another quiet one? Or?
Picking up on that in terms of sort of the sentiment I'm picking up is that they're buying, but they're not buying as much. They're not too sure. Like, I mean, I guess retail sales number, etc., is still pretty soft out there. I guess infrastructure spend in terms of equipment, just hearing around, I was on the road last week in Tauranga, still not willing to commit in terms of, there is stuff floating around, but they're not willing to commit too heavily in terms of locking foreign exchange, because of they're not certain around the volume and the value of those transactions and what's going to transpire in the current environment. So you're still seeing a bit of that play out.
Yeah. It's just all that uncertainty right now, right? Which does make it a little bit concerning that maybe this is all just a 2026, just pushing out that recovery.
That's what it's looking like, isn't it?
Uncertainty,
Yeah.
And I think, in terms of currency being in the 58s, that is also playing a factor in terms of the decision-making process around the cover. Kiwi being at 50 cents against the euro, being at 90 cents against the Aussie, that's all sort of playing in the back of mind of importers. They're prepared, okay, we'll run at spot for now and see what transpires, but we'll hedge what we have to if it's tight margins on their product. But anything that's got margin built into it, they're probably more not running a risk, but prepared to sort of see where it goes. And if it heads back towards 60 against the US, they potentially will lock in some form of hedging.
Is there any regret? I mean, we've only just recently dropped into the 58s. Any regret from importers, or are they just going, okay, now we just have to wait for the bounce?
Yeah, I think when we initially talked to them, when it was at around 60 cents, they weren't willing to commit. Yeah. So I guess it's probably, I wouldn't say regret, but it's probably sort of, I wouldn't even say hindsight, it's more of economic conditions at the moment. They just haven't been willing to commit. And I think they realise that. And
it doesn't matter where the currency is. They're just not. They just don't have the demand.
Yeah. Even when we're at 61s, we're ringing our importers, and they'll do a little bit, but don't only do the actual minimum amount required in terms of the hedging. So that's what was sort of flowing through.
Yeah. Uncertainty all around.
Yeah. Feels like very, sort of downbeat. But I mean, there is some optimism out there. I think we're sort of, hearing from some companies that are saying that there is a little bit of opportunity out there, but it's just going to be a really slow grind. And I think it's a 2026 story.
Yeah. Yeah. No, I think that's frustrating a lot of businesses, right? We were talking about survive till 25, survive till 25, and then here we are, and it's like, now it's a 2026 story. I think that's really frustrating businesses. That's been a big disappointment for them. This was supposed to be the year of recovery. It's now going to be, just a year of bumbling along, and hopefully recovery next year.
Yeah.
I had a client I was talking to a couple of weeks ago who imports steel for sheds. And a lot of it, the steel goes into sheds for on agri, and they have seen a big uptick in terms of demand for their steel products for implementation sheds on dairy farms, for example. So that's kind of like a green shoot that we're seeing, but there's only one area, and in their terms, the commercial space is still quite quiet.
Yeah,
and also the residential, is along with the infrastructure spend as well. So, but that's one part of the area you're starting to see a little bit of an uptick.
Yeah,
I guess replacement of existing equipment.
Yeah, and that's the one bright spot, isn't it? It's the agri and the farmers spending more on the farm, but what we're noticing is they're not spending it outside the farm. So they might be building a shed or buying a tractor, but they're not buying, I don't know, the ute or the holiday
or the boat, or etc.
Yeah, and you mentioned commercial space being quite weak. I was at an AGM last week presenting to commercial property. And interestingly, they were talking about how, they used to do all these big projects, buy an entire building or build an entire building. Now they're focused on very small projects, just ticking over, doing the small stuff. So there's green shoots, but I think we're still quite a way away from, commercial and construction in general picking up.
It's so interesting because green shoots is not what we were expecting to see in August, a whole year out since the Reserve Bank.
That's right.
This is something that we we're hoping to see kind of at the beginning of the year, which would then lead on to the more broad-based strength. But that broad-based strength is really lacking. And the retail sales you mentioned was a really good quarter, up 0.5%. It follows pretty good strength over the last few quarters. But again, it's very concentrated in just a few regions, in just a few sectors. So it's not quite the broad-based strength we're getting, you know.
I mean, I guess with a weaker Kiwi or softer currency, that's helping us in terms from an exporter point of view. And that's why we're still seeing a lot of activity in that space, which is great. I mean, would it be much different if it was above 60? Potentially, but I think you're still seeing those clients are still able to partake and participate in terms of, even with the tariffs going on in the US, are still exporting overseas and still seeing demand there. It's just albeit not as strong as what it was, but still,
Yeah, I mean, we export meat and wine and stuff that the Americans just going to keep buying.
Yeah.
And the drop in our currency will help with the payment of the tariffs, right? So, yeah, we're not worried about that. What we're worried about is outside that export sector, which is still struggling.
It is.
On your importing side.
Yeah. Actually, on those tariffs, have you seen much reaction to it? I know the last development that we've had is that Australia, our closest trading partner, is 10%. We're on 15%. Has there been any, from what you're hearing?
I did have one where I talked to an exporter who's in the primary sector in the sheep and beef exports into China, and they were being impacted by Brazil, who's got a 50% tariff out of it. And so now they've turned around to exporting their beef into China, which is impacting their price, what they can sell into China. So they're feeling the effects of that, because that was their market, but now competing with Brazil in terms of that. So they're now looking at what they can do in terms of the US, but that takes time to build that market. So
that's a great example of the trade diversions that we've been, predicting will happen, right? And the deflationary impact of that. You get a country like Brazil, not small when it comes to meat exports, dumping into China, reducing the price that we get.
Yeah.
And on top of that, they're struggling to get container space, chilled containers.
Yeah, right.
So, and trying to get booking, slots available on ships to export.
Yeah, right.
That's what they're struggling with as well. So and also higher prices for sheep and beef in New Zealand and limited supply. So there's a bit of a double-edged sword there as well. You've got softer prices in China because of what Brazil's doing with their meat, and you've also got a supply issue here.
Yeah.
We actually talked about the shipping with you last year.
Yeah.
We did, yes.
Yeah. So is it good, bad, or worse?
From what I'm hearing, if you're an importer, yes, you can get space on a vessel quite easily.
Yeah.
There's actually a lot of empty containers coming down into New Zealand. Like shipping lines are bringing empty containers to backfill to be exported. But what you're finding, you still got that, I guess, the ability to book space on a vessel, but also trying to get your hands on containers, especially in the chilled space, in the frozen or the chilled exports. If you haven't got space booked on a vessel, you struggle to get space on it. But once you're on there, there's no sort of real delays in terms of shipping times. It's more getting that space available.
Yeah. Did you see any disruptions during, I guess, closer to the Liberation Day kind of time? Or is this something that's just, is this better than what it was in April?
I think it's just been ongoing. It's
Ongoing.
And it's just more around obviously the whole supply logistics, how that's been playing out in terms of where the containers are ending up, and in terms of, I guess, where the demand and where products have been supplied. But we haven't seen a direct impact as such per se, no.
Guess it's good news.
Yeah.
So it seems like next year will be the year that we actually see a bit more recovery and a bit more activity come out. What is the sort of sentiment among your clients? Is that their mindset, just waiting until next year?
That's the sense I get. I think a lot of it's coming back to when we're going to see the government actually open up its checkbook in terms of actually starting to do infrastructure spend. Clients they're waiting. They're just sort of almost in that hibernation phase, waiting for them to start, spending money, and then they'll commit to some form of equipment, etc., or spend. You're not hearing too much in terms of hiring going on at this stage. It's just really just sort of treading water. I think also with obviously the cash rate being at 3% and the expectation being at 2.5%, you're starting to be built in. It's now really going to be what is the government going to do in terms of spending? Are we likely to see at the end of this quarter, end of this year, or early next quarter? And that's when I think you'll start seeing a bit more. I guess you're going to see a bit more conviction around, willing to commit to spend.
Yeah.
and whether it's equipment, etc. I think that's yet to play out.
All right, well, that was great. Lodge, thank you very much for coming back on, and we'll hopefully get you back on within a year this time, and we're going to pass the hat around and see if we can get you a new shirt for the next episode. From our point of view, everything you said's kind of what we've been seeing. The weakness in importing is due to a weakness in consumption and household demand here, and the bright spot has been the exporters, and I think the Kiwi dropping into the 58s very good for the economy, very good for exporters, and helps with those tariffs. So. Thanks for coming on and explaining that and giving us a few anecdotes.
Thank you for having me.
Cool. That's it from us this week. Tune in next week, but until then, please like, subscribe, and follow.
You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.
Any views or information shared in this podcast, while given in good faith, aren't necessarily the views of Kiwibank.